Thank you. Good morning, everyone. Thank you for your time. I appreciate it on a Saturday morning. The prior speaker did a phenomenal job at, I guess, presenting the investment case for Japan. And I largely agree with most of what he said. So I'm going to quickly reiterate some of those key messages as we see it on our desk. And then I'll talk about how we actually invest into Japanese equities and talk a bit more about the fund and its positioning. So firstly, in terms of our outlook, the long-term investment case, I think, is robust. Okay, so year to date, Japanese equities are up 25% in yen terms. That's really strong. It's been a very strong 6 months. That's been driven by stronger earnings than people were expecting. It's been driven by more foreigners coming into the market and actually buying Japanese equities, partly as a hedge against some of the tensions in China and some of the softness in Chinese economic data, but also partly as a hedge against maybe a US recession later this year. So Japan is in a bit of a sweet spot at the moment. And that's a combination of both sort of short-term tailwinds and longer-term tailwinds. And let me talk you through those, because I'm sure everyone is asking the same question: is can this rally in Japanese equities continue? And if it can continue, to what level can you expect it to go to? In terms of the long-term fundamentals, valuations are still attractive. So they're still cheap relative to their own history and still cheap relative to other global equity markets such as Europe and the US. In terms of corporate reform, which the prior speaker touched on, this has been ongoing since Abenomics in 2013. So we're on a journey, okay? We're probably halfway through this corporate reform journey. Japanese corporates many years ago were terrible at allocating capital. They were terrible at cutting costs, and they were terrible at restructuring their businesses. But a lot of that has changed in recent years, and as we sit here today, I believe the corporate reform story is going to be one of the key drivers for the next 5 to 10 years for improving underlying profitability at companies. And that is the third structural sort of long-term point, is improving margins. Margins in Japan at the corporate level have always been quite small. They're improving, but from a very low base. They're still below Europe, far behind the US, and they can get better from here with some of those corporate reforms I mentioned. The shorter-term cyclical tailwinds which we've seen, which is sort of partly the reason why Japan has been in demand this year, are the fact that Japan was late to reopening from COVID. So they reopened about 12 months ago, but there's still pent-up demand for spending. I was in Tokyo a couple of months ago, and Ginza, the key shopping street in Tokyo, was really buzzing. Not full of tourists, but full of locals wanting to spend money. So there is that pent-up demand to buy things and travel, and people are actually using savings, their buffer of savings, to do so. The second short-term tailwind is China. So China was very late to reopening from COVID, and there's two reasons why Japan benefits from that. Firstly, Chinese tourists were a big part of the tourism industry in Japan. So as Chinese tourists come back to visit Japan, they'll be spending money. They're big spenders on luxury goods, on cosmetics, and that will be beneficiary going forward from here as airline routes and visas open up again. The second reason China reopening is important for Japan is that China's economic machine is huge. And once that gets back up to full speed, there's a high demand for inputs into that manufacturing process. And Japan, although it doesn't manufacture raw commodities and base commodities, it does manufacture high-end inputs in terms of plastics, glass, carbon fiber, and chemicals. So they've got a really big footprint globally for these sort of things, and that feeds into the economic machine in China. So we're seeing stronger demand for a number of the companies that we own in the fund. And the final sort of short-term tailwind is the removal of supply constraints. You'll remember during the sort of COVID lockdowns for a couple of years, semiconductor chips were quite hard to get. Getting hold of a brand new car was almost impossible. Buying a high-end camera was difficult. But what we've seen in the last few months is some of these supply constraints really have now largely been removed. So for the manufacturing base in Japan, they can actually ramp up capacity to full levels. And that's especially so for the auto manufacturers. Very quickly on this final slide, fund positioning for us. We are overweight financials, overweight autos, and overweight materials. We have a 40% discount in the stocks we own to the market price to book valuation. So Japan is cheap, but the stocks we own are even cheaper. And I'll come on to that point in a minute and elaborate on that. And then finally, we have 65% upside to our own valuation targets for the stocks we hold at the moment. So although Japan is up 25% year to date, we still have a lot of upside for the positions that we hold. So we're still quite excited about the future. I'm going to show you a couple of quick charts. Firstly, valuations. So price to book of Japan on the right-hand side in red is 1.5. That is up from 1.3 at the beginning of this year. So valuations have moved. But even though they've moved, it's still cheap compared to Europe on 1.9. And arguably, Europe has a stagflation and a growth problem and doesn't have the structural corporate reform tailwinds that Japan has. And the US is now on 4.3 times price to book. So very expensive. And most investors I speak to around the world, whether that's institutional clients in the US or family offices and private banks in Europe, they are starting to take profits in the US, reduce their overweight to the US, and actually redeploy that into some Asian markets, but also particularly Japan. And that's what we've seen year to date. Okay, so corporate governance. The prior speaker talked about the cash-rich nature of Japanese companies. So the chart on the left-hand side here shows that the TOPIX, on average, a company in the TOPIX has, 57.9% of companies in the TOPIX have net cash on their balance sheets. That means they have resilience. So if we do have a global slowdown later this year or next year, there is a global recession. Japan is not going to be immune. Japanese companies are pretty resilient, so they can weather that storm. The more important reason why cash on the balance sheet is important is because with a little bit of pressure, corporate management teams can actually be pressurized to return some of that cash to shareholders through improved dividends and more share buybacks. And that's very important for equity investors like us on our desk, but also ultimately for you who own the fund and have exposure to Japan as too. So the opportunity for Japanese companies to return that cash to shareholders is pretty big. And you'll see that on the left-hand side here with dividends and share buybacks having gone up from a very low level in 2001 to a more reasonable level in 2023. And we expect that trend to continue. One of the key things in the corporate reform arena at the moment is the Tokyo Stock Exchange. They've announced an initiative back in February this year to challenge all companies that are cheap, they're trading on less than 1 times price to book, to improve their profitability. Now in Japan, if your company is on this list, you're effectively being shamed to improve your profitability, improve your ROE and your profit margins, and ultimately improve your returns to shareholders. And shame is a big motivator in Japan. People don't want to be publicly on this list. So corporate management teams over the next 12 to 24 months are going to be announcing more share buybacks, and they're going to be announcing more restructuring and looking at underlying profitability. Historically, that wasn't always important. As of today, it's very important for CEOs and CFOs to improve their underlying profitability. So that's a longer-term structural change. It's not fully appreciated by investors globally yet, and I think that's one of the main sort of drivers over the coming years. A result of all that is going to be better margins. This is profit margin as a percentage of sales. Back in the 90s, margins were wafer thin. As I said earlier on, Japanese companies were not good at allocating capital effectively, but they have improved. But at 6%, which is where margins are today, that's still below Europe and way behind the US. So as I said, we're on a journey. We're halfway through that journey probably. Japanese corporates can improve their underlying profitability. So if you're going to remember 2 things from my presentation today, remember that Japanese corporates are still reasonably cheap. And secondly, profitability of corporates is probably going to improve going forward from here. And from an equity investment perspective, we can complicate it by showing you 100 charts. But when it comes down to it, those two things are absolutely critical. And with more foreign buyers coming into the market, most of them are massively underweight, looking to increase their exposure to Japan. You should see a continued re-rating for the Japanese market over the next sort of 1 to 2 years. What happens in the next 3 months, I don't know. I think it would be healthy to have maybe a little bit of a pullback. But on a medium-term, a long-term view, the structural case for Japanese equities is very strong. Just cognizant of time a little bit, I'm going to rattle through a couple of extra slides. So wage growth in Japan has been anemic for so long. People haven't been given wage increases, and therefore psychologically they've not wanted to spend or invest. That changed early this year. We've seen wage growth of 3 to 5%. That's a step change from the last 20 years, and is very, very important. With a little bit of wage growth, with a little bit of inflation, Japan has had the best chance in a generation to move to a more inflationary environment. So some people think inflation's bad in the US or bad in Europe. Well, if inflation's 10%, then yeah, that's not great. But in Japan, a little bit of inflation, 2-3%, it's a game changer. And you can move from that deflationary environment we've had for 20, 30 years into one which is a bit more self-fulfilling around growth with a little bit of inflation. The other chart is on tourism. Tourism had been built up over the 10 years prior to COVID to being quite a meaningful part of the economy. That obviously stopped during COVID. We've seen a bit of a rebound, but we haven't seen a full rebound. So expect tourism to continue to drive the economy in Japan, especially the Chinese tourists that I mentioned earlier on. The elephant in the room is yen, is the currency. What happens to the yen? At the moment, yen is 143 against the dollar. That's pretty weak. This chart shows 20 years of history. So the red line shows dollar yen. An average is around 110, 120. So at 143, it's pretty weak. So if you're looking to go on holiday, go to Japan. We all love Japan. It's a great place to visit. But at the moment, with the currency, it's also quite cheap. What that means, though, from an investing point of view, is that manufacturers that export are actually pretty competitive globally. And that's quite important. What happens medium to long term? I do think there'll be a bit of mean reversion. If we do get slightly tighter monetary policy in Japan, which will happen at some point, you'll see the yen probably strengthen again against the dollar. But at the moment, it's at a very sort of extreme weak level, and you can exploit that. So that's more on the markets. It's reiterating some of the points from the prior speaker. Let me introduce you to sort of how we invest and the team. And I'll rattle through this quite quickly. So there's 4 stages to our investment process. We are a long-only Japanese equity manager. We hold typically 35 to 40 stocks. We're low turnover, typically around 25% a year, which means that if we buy into a stock, we hold it for 3, 4, 5 years. We're not short-term traders. We are very patient, long-term, contrarian investors. And that's quite important to have a robust process around what you do. The 4 stages, firstly, idea generation. We take 2,000 stocks in Japan into our screening process, and we look for those companies that have derated versus the market. So those that are 1 standard deviation cheap on price to book, price earnings, dividend yield, and price. So we're not looking necessarily for the cheapest companies, we're looking for those that have derated. And what we want to understand is where the market is getting the earnings wrong. It has a very pessimistic view, and in our view, that's incorrect. So if I see a company that's derated by 1 or 2 standard deviations, it has 10 sell-side analysts that all hate the stock, but in our view, on a 5-year perspective, earnings will recover, then that's a great investment idea for us. A good example is Kirin. Kirin is a beer manufacturer, a brewery in Japan. During COVID, the market sold off Kirin massively because of concerns around the fact they were not selling much beer through the pubs, through the bars, through the restaurants. But in our view, that wasn't going to carry on forever. So we exploited that, bought into 𝗬𝗲, and then last year, as COVID sort of largely ebbed away and Japan reopened, 𝗬𝗲 breweries, the stock, re-rated very strongly. So we're looking for those periods of mispricing in the market that we can exploit as investors. We're trying to exploit that short-term pessimism that a lot of the market has. The second stage is fundamental analysis. Our fundamental analysis is bottom up. It's very stock driven. We spend 2 or 3 months building a model, talking to CEOs, talking to CFOs, talking to suppliers, other people in the industry, consultants, to really build up a deep valuation model on a stock. And we look for at least 60 to 70% upside before we invest in a company. In terms of portfolio construction, we typically take a 1% position initially, and as our conviction levels build, we'll increase that position up to 5 to 6%. And then the fourth part of the investment stage is risk control and review. We have a weekly team meeting where we talk about all the stocks in the portfolio, and we have a monthly risk meeting where we look at some of the top-down risks. The team, we're all based here in Singapore. We find that a slight advantage. We don't need to be based in Tokyo. Sometimes as an investment team, if you're based in the local market, you're subject to a lot of market rumors, a lot of market noise, and that isn't really what drives long-term valuation and long-term outperformance. So being based here in Singapore, we get plenty of corporate access, seeing CEOs and CFOs. We also travel to Japan a lot to meet the companies on the ground. But we're happy here. It's worked for us. We've delivered 2 to 3% outperformance a year over the last 16 or 17 years. So yeah, it works well for us. 𝗪𝘰𝘃𝗀𝘁 on the left, he graduated in Japan. He's a fluent Japanese speaker. He worked for Fidelity for 10 years before joining us. He leads the team. Max on the top left, same haircut as me. He runs our smaller company strategy. He lived in Japan for 15 years, married to a Japanese lady. His Japanese is amazing. His accent is incredible. Sam, he is Vietnamese, but he did an MBA in Japan. Charlotte studied in Japan and worked for Goldman's on the sell side there for a few years. So as a team, we're not Japanese nationals, but we have a really deep understanding of the culture and the drivers from a corporate perspective. And we have a dispassionate view of investing into companies. We're not subject to some of the local biases, which local management teams can be. In terms of performance for the fund, year to date, the fund, which is the Singapore dollar hedged share class, that is up nearly 15%. That's relative to the market, which is up 17%. So a slight underperformance. Most of that is due to the fact that year to date, a lot of the high growth technology companies, such as Advantest, have done very, very well. And we don't own much in that area because it's very expensive. We look for slightly cheaper companies, and we have a value tilt to how we invest. On a 1 and 3 year basis, the fund has delivered 23.7% on a 1 year and 24.2% on a 3 year basis. That's per annum. So returns have been phenomenally strong. Can that continue? I think the structural case is definitely intact per my comments earlier on. Will it carry on at 20-25% a year? Probably not. Experience would suggest that's very difficult to sustain. But I do think Japan's very well placed, and we can continue to see strong double-digit returns going forward. In terms of the positioning, as I said, the table on the right-hand side here shows our sector positioning. We're overweight autos because they're restructuring their businesses, and that is not priced into the market currently. Financials, we have a small overweight. As we move from a deflation to an inflationary environment, a lot of the banks and financial companies are going to benefit from that. And domestic companies, supermarket chains, retailers, we have an overweight there as well. They are laggards in the market, and we think there's a huge valuation opportunity there as Japan reopens. In terms of the stocks, you'll see our top 10 on the left-hand side. Some of these names you're going to recognize: Panasonic, Honda, NEC maybe, and some of them you won't recognize. If you get on a train in Tokyo, you're probably going to use East Japan Railway Company. They're benefiting from a reopening. Things like Daito Trust is a small mid-cap name that builds properties and leases them out. Again, it's benefiting from the fact that Japan is now moving from a deflationary to an inflationary environment and is reopening after COVID. So I'm just going to finish on one final slide. Go back. So just to sum up the opportunity, I think the Japan investment case is very, very solid. There's lots of opportunities. We still see valuation upside in Japan. We have a very robust process, very repeatable. It's been stress tested over 17 years through bull markets and bear markets, and we deliver 2 to 3% alpha through a cycle. And that's important for potential investors. We're looking for those outliers. We are contrarian. We are value investors. And we have a very experienced team. The sales guys in my team have said that we have both Singapore dollar and US dollar hedge share classes available. So if you're interested in Japan, you're interested in our fund, please speak to me or one of my colleagues outside. And I'm going to end it there. If you have any questions, please come and see me. Very happy to help you. Thank you.